All right, everyone, we're back today with Matt Warder, who is our promo prognosticator. He has for the last several years, as I keep beating the drum on, um, found a way to kind of not just use his analysis in the markets to help predict where the markets are going to go from an investment standpoint, but apply it back to FinPub and what kind of promos are going to work. And we've been tracking this now for, I don't know, since COVID started.
Yeah.
And generally speaking, Matt keeps kind of nailing the periods where tech promos work, fear promos work, where you can see like the Rickard stuff takes off, right? What he says gold and things like that are going to work. And then when we have these pullbacks in big tech promos, it's not too much of a surprise if you've been tracking what Matt's been talking about. And so what Matt's going to do today is kind of give us an update on where he sees things right now, where he sees 2025. And the reason that we do this is so that you can, as publishers, think about like what promos are in your pipeline so that you're not relying entirely on a big tech promo when maybe we're going into a quarter where there's going to be a lot of fear or a lot of pullbacks that then kind of kills your promo. So like kind of balancing out your promo portfolio to kind of fit the market environment is part of the art of being a publisher. And so Matt, how the hell do things stand today? This is March 18th, 2025. Where are we at?
We're kind of in no man's land, if we're going to be honest, right? When I was on a number of podcasts to kind of start off the year to talk about this very thing, like Matt, what's your take on 2025 coming up? And in all honesty, like this is the one year out of the last five that I've come into the year without a whole lot of big ideas. And part of the reason is because we've gone from a policy environment and a geopolitical environment that is, uh, you know, I don't want to use the word stable to imply good or bad or whatever, but like stable and predictable to one that is less stable and comparatively less predictable, right? You know, we don't want to debate individual policies or do anything like that, but we have to acknowledge that the environment around regulation has just changed. And the world and the actors within it, both from a geopolitical perspective and an industrial perspective, are changing along with it. Like nothing is static. And the difficulty with that, John, is like when we've done this before over the past like 4 or 5 years, we've been in these very, very predictable, very extreme situations. If you think about the COVID lows as holding a ball underwater, when you come to that year on year comparison, you know that, well, if we have the lowest GDP of all time, the next year we'll have the highest GDP growth of all time, right? From
Right.
the biggest dip to the biggest year on year growth we've ever seen. That was inevitable. Like we knew from a mathematical standpoint that was going to happen. And I talked about, I think it was in 22 or 23, the fact that like over the years, we would eventually see those waves start to even out. And we kind of have. So the reason we're having this call is I just updated my forecast on the macro basis for year end, looking at GDP and inflation. And for those who don't necessarily remember, why we want to look at GDP and inflation, I'll just share this really quickly.
Yeah, you'll be great. Just if you're gonna put up that the four quadrants and kind of what
Yeah,
promos work and which one. Perfect.
yeah. So let me do that here. Um, all right, can you share can you see that here?
Yep.
Okay. So the quadrants, if we think about just GDP and inflation, it's a two-factor model, right? GDP goes up and down on a percent growth basis, and inflation goes up or down on a percent growth basis, right? From quarter to quarter, from year to year. I use year on year comparisons because that's what the market looks at, for better or for worse, right? Short-term directionality looks at quarter on quarter or month on month, but broader market trends all line up better with year on year. So, if one's going up and one's going down, we have these four outcomes, right? Both up, both down, and then, one going up and one going down. And if we turn those into quadrants, I call those reflation, inflation, stagflation, deflation. They're all either the economy is growing and churning and prices are getting higher, or the opposite has happened, or a mix of the two of those things. And from a equity performance perspective, from a stock performance perspective, we generally tend to see growth-oriented things work when GDP is rising, technology, retail, consumer discretionary, industrials, and smaller cap ideas tend to work better which is, you know, a big portion of the FinPub industry during these reflationary periods, you know, mid caps, small caps, et cetera. When the opposite is happening, which is kind of where we're at right now. I mean, Scott Bessent and Trump have both been on TV talking about you should expect volatility, and you should expect, you know, the market correction. And now they're saying the stock market isn't the economy, you know, compared to the opposite conversation during the first Trump administration. And I think that is a clear message that they're not going to protect the market here at this point in time. Instead, they want to protect the 10-year yield. So they're trying to make the yield go lower. And why is that? Well, the only way you can do that is to cause some kind of deflation. And deflation you generally see first in the stock market. And we're kind of seeing that here right now. So in those situations, you know, the defensives work better, right? Utilities, staples, gold is over 3,000 today. We've been talking about gold for 5 years. You know, that's an insane amount of time to talk about one commodity, but in that period, it's gone from, you know, basically $1,000 to $3,000 per troy ounce. And yet there have been precious few gold-focused publications that have emerged as a result.
It's very interesting that the big one being, of course, Jim Rickards, and how when everyone else was sucking, his was doing well.
Oh, crushed it. Yeah.
Rickards was doing great, right? And the thing it should be very unsurprising to anybody who's been in the industry very long that when we are in those difficult periods in the market, that gold has always kind of been one of those things. And Rickards in particular, since what, 2017, 18, has been kind of like, hey, nothing else is working except for Jim, right? Because that's what worked. And so the fact that if you as a publisher are ignoring that side of the market and you're having those difficult periods, it's something that, like, once again, you need to consider from a product perspective and a promo perspective, whether it's having a product or having a special report and a promo for a product that you already have, that
right
at different times you need something in that area if you want to kind of go out with it.
Yeah, again, and if your publication is more options oriented, or, you know, you're not agnostic, or your readers aren't there, you know, again, and I've said this a million times, like you can reach out to me, or you can reach out to, you know, our network of folks, you know, pair you up with an analyst who can articulate exactly why gold is doing something, or exactly why some other commodity is doing something, or something in the supply chain. So like, you guys don't necessarily have to do that, but it's good to know people who can contextualize things that are happening in the real world to your readers. I mean, that's part of trader education anyway, right?
It's super interesting too, because now with the FMS Pro Discord, I noticed, like, excuse me. So we had a really strong January start to January. Around the third week of January, sentiment drops and things are starting to get difficult for everybody. And then the media buyers, like, who are kind of out there as CPA affiliates and really driving traffic for things, I noticed start popping in. Like Sally Holton was jumping in the Discord and like, hey, who has a gold promo? I'm looking for a gold promo, because that's what's converting. And they want more promos like that. And so that is a repeating kind of pattern that we see. And that's why I'm kind of being super redundant here and saying, like, you know, having a gold promo, having a fear promo, having a short promo, whatever it is that you have that's targeting the difficult times, like, you need to have that as a part of the mix in the business, especially if you have tighter margins at this point. You need to kind of be moving a little bit more speedy in terms of switching your promos.
Yeah, and to put it back in terms, like, you know, here I've just taken, you know, this sector / factor type of you know, diagram, and just turned it into, what types of promos work in these environments. And basically, when GDP is going up, that's when you can sell tech and growth and the next big thing. And it's super easy to sell trading systems and option strategies when you're just buying calls and the market's only going up. But like, when you're in this environment, you know, you need a crash insurance type of promotion, or gold, or you just need something to either engage your audience with and say, look, we know this is happening, and then redirect them into a product that is appropriate for them, you know, or alternately, you know, develop a product or bring in outside expertise to contextualize products that you do have, in order to so people kind of understand that you've got it under control. You're aware of sort of what's happening. Your readers, your subscribers are, well taken care of, et cetera, et cetera. But like this is the environment that we're in. If I graph that and I actually just put it up on a graph, let me show you. So this is the same scale, change in GDP versus the change in inflation. And in white here is my forecast for the year. We just came out of Q1 in a stagflationary period. Remember, the market topped out, and now we're heading into a more recessionary period or a deflationary period. And to be fair, like this might have been pulled forward into Q1. I don't know that for sure yet. I think probably, we'll see a rebound from here. We have the big options expiry on Friday for the month. I think after that, you'll probably see the market, kind of melt back up to, to test highs where it was back in January. That wouldn't surprise me at all. But, at least from a macroeconomic perspective, I don't think that's sustainable. I don't think it'll last. So I kind of expect us to move into, a short recession and then right back into kind of stagflationary, environment. And I think by the end of the year, a lot of the uncertainties in policy, a lot of the uncertainty in, how we're going to behave with our trade partners will mostly be worked out. And when you get about 3 to 6 months of stability on that side, and people actually start to get used to it, that's when I think you'll see the economy start to grow again. But like this is barely over the line. This is not a huge movement. And just to sort of illustrate how easy it was a few years ago relative to now, like here's that same chart on the same scale. Here's where we are now. Look where we came from. Like the change in GDP and the change in inflation were insane the last 3 years. And it was only in 2024 that we've seen this finally circle back to circling around the origin. Now, the difficulty with this is the closer to the origin you get, the more volatile the market is going to be. Now, not like insanely volatile. We're not going to crash or anything like that, I don't think, or at least if we do, it's not going to be in a straight down kind of environment. It's going to be, 10% here and a retest of highs, and then maybe 15%. And then maybe get to another lower high. I think it's going to be, we're going to take the stair steps down, not the elevator.
Right, so on this chart, you have like, obviously there's all these big moves,
This
right?
is GDP. This
They're
is
flying all
inflation.
over.
Yeah.
And then now we have this little like chicken scratch knot right there in the center.
Yeah.
So
So
like,
let me change the scale on this just so you can see how dumb this was. This is where we are now, right? Here's where we are. This is where we came from. This is 243. You can find it. This is Q1 of 2021. Remember how easy it was to sell newsletters in Q1 21?
yep.
Short squeezes, all-time highs, GameStop shenanigans, et cetera, et cetera. Well, look where we are now. Like, so we're just not going to get the same kind of behavior or the same kind of action or the same kind of interaction from subscribers with the market now than we were then. The headlines just aren't as extreme. It's different time. You got to take a different approach. But like this should show you how much harder it actually gets when we're this close to, very little change in the economy from one quarter to another. And if you think about, the dot-com crash, right? From back in
back up real quick.
I will.
That. Go ahead.
If you think about the dot-com crash, like from 2000 until 2011 or 2012 or something like that, basically the market went nowhere. And I don't think we're headed into that kind of situation. But I do think that's going to be similar to the environment we're going to be in for like 12 months. I'll bring this back up now.
Well, I was going to ask, could you point out just to kind of drive the point home here, 2022, if you go back,
sure,
and show when in the worst of the industry's kind of issues, where things were kind of flying
in the worst. So this is negative 173, negative
second half 2022.
Again, 938. 2020 Q2. That's the worst of it. That's COVID.
No, 2022. When
Oh,
like
2022.
right. So yeah, we had 2020. You have right before COVID hit, everything kind of froze for a few months, and then bam, it blows up and goes up to that peak into 21, and then we had that big pullback in the industry where things kind of like got difficult.
Mhm.
And I'd say that was like late 22 into early 23, but like mostly it was 2022.
Yeah, well, I mean,
Um,
just looking at 22 here, I can't
and there
identify.
are a lot of factors going on in there,
Yeah,
but
so 130 positive 133 on inflation is like,
right.
yeah, it's 2023 133.41. Um, it's going to be in,
Right around the line.
yeah, let's see this one, negative 97.98. Here's 2022 Q4, right?
Yeah. Okay.
So
So that area is, yeah, not
yeah,
great.
yeah. Well, we also had in 2022 inflation going crazy in Q1 and Q2.
Mhm.
So those are going to be out here, right? Here's
And we
here's
had,
2022 Q1,
and so we were
and there's
having
here's
this choppy sales.
yeah.
Like we'd
So
have a
here,
month and be like, we're coming back. Oh wait, we're not coming back. We're coming
yeah,
back. We're not coming back.
yeah.
Um,
So we had come from, so here's 2022 Q1 and Q2. Here's the prior year Q2. So we went from crazy bullish to
mhm.
really just less bullish.
Yeah.
2022 wasn't a disaster year, but things quit working because everybody went back to work. They weren't, plugged into
Mhm.
markets. Um,
Yeah. That there was a lot of factors in that one,
yeah.
but
So like, here it's like this isn't a terrible position to be in from an economic standpoint. It's just slight negative GDP growth. It's not
mhm.
like COVID.
Right.
Right? It's not all the way down here. Or which one's this? This is 143,750. Here it is. That's Q3, right?
Mhm.
So we went from here to there to here and then all the way down here. We're here, again. So I don't think we're going to see the same kind of rate of change of, scary subscribers that we saw in 22. It's just a different environment. I think, for the most part, businesses have uh, stabilized probably isn't the right word. I think there's a lot of churn.
Mhm.
And there's also a lot of churn from a demographic perspective, right? We're moving into this new paradigm where we're going to be less reliant on boomers, more reliant on Gen X, which is a smaller generation, by 10% or thereabouts. And millennials and Gen Z, et cetera, are interacting with products now, but they're not interacting in the same way that their prior generations really have.
Yeah.
So,
They're invested. They're interacting with the market at a greater for their age, a greater percentage for their age relative to previous generations. But
yeah,
millennials haven't really hit their prime investing years yet.
right.
They're more active where they're at than any generation before for that age, but give it a few more years before they, because investing and trading really hits pre-retirement, and they're not there yet.
Gotcha. So yeah, to bring it back home, again, like we're not in that wild environment. We're in this actually pretty tight macroeconomic environment. And I really do think that although it will take some time for the supply chain and for subscribers and for everybody involved in markets over the next like 6 months to sort of digest the change in administration. But I do think once that happens, we'll probably see some kind of resolution to the upside, and whether that's in Q3, Q4 this year or Q1 next year. Like I do think, just from a rate of change perspective, that's going to look that things are going to look okay. This is a
And
temporary
so,
phase, not a you know complete sea change in the business.
right. So then for the next, 6 to 9 months, what are we looking at, do you think, from a promotional standpoint?
Well, I mean,
We ended last year with a lot of the AI and Elon Musk promos, obviously coming into and out of the election.
mhm.
Um, that was kind of working leading into January, and then when sentiment dropped and everything changed, then we had these gold promos. So you had kind of a bullish and then bearish kind of dynamic here. Where do you think we're going to go?
Well, let's actually just take a look at some of the search terms and go from there. Let me know when you can see my
Yep, I
screen.
can see it.
All right, so you see the rolling 30-day search scores?
Mm-hmm.
Okay. So let's look at some of those things. I think I have them on chart 4. So this is it's a Z-score. So this is normalized. This is Google Trends data. Artificial searches for artificial intelligence on a relative basis peaked on January 27th, which is right around when NVIDIA peaked as well.
Right.
Either a session or two before or after that. And then the market began to correct. When the market corrects, people are less interested in searching in general. We had a bit of a turnaround in February, but notice how we're coming up to a lower high. So the same thing happens in search that happens in technical analysis, because both of these things are measuring human interaction with something, whether that's buying and selling in markets or just general interest when you type something into the Google search bar. It's a proxy for sentiment, right?
Mm-hmm.
And I think this is telling you that we're not going to get really back up to the highs of where we were. So, this is probably peak performance of AI promos. Does that mean they're not going to work? Of course not. Of course they'll work. They're still engaging with people, just not as engaging as they were. Similarly, generative searches for generative AI peaked in January. Searches for semiconductors peaked on January 31st. So, like, all of these things are consistent with how markets have performed. And although, I think what you're seeing here is the beginnings of an inflection. I think we'll probably have a decent April, like I said, or a decent last part of the month after we get past this options expiry. And I would expect these numbers to go up. But again, if we're heading into what I think is, I'm going to call it a recession. I don't think it'll be very consequential. I think it'll just be a slowdown for like 3 months, and I think that's deliberate. I don't think they want to. I don't think Bessent and Trump want to crash the economy, but I do think they want to slow it down. And they've taken the market narrative that this Biden economy has been overheated, right? And the Trump economy will emerge sometime next year. Like Bessent has actually said that on CNBC, and it's hard for me to watch that and go, well, that's bullshit. Like that seems to be what they're trying to do, and the message has been totally consistent. They're defending the 10-year, they're not defending the market. Expect some volatility. We need this Biden economy to cool off. Like these are phrases that are coming out of their mouths. So we shouldn't necessarily be surprised at that kind of movement. And again, like their comments are consistent with just what we see from a macro perspective in terms of the general rate of change of consumer spending. It's not great now. Eggs were super high priced, and now they're going to be a little bit less so. The inflationary topics that hit on CNBC, on Bloomberg, etc. Those are becoming less important, less prominent. And I think the other thing to really understand thematically is that when we talk about these things, the Biden economy was largely driven, and we've talked about this on your podcast, by two uncapped fiscal programs, right? The CHIPS Act and the Inflation Reduction Act. Those are, for all intents and purposes, dead, gone. There's not going to be any more money that flows into them at all. What I don't think Trump and Bessent were counting on is the fact that the tariffs are inflationary, which are run counter to wanting to pull down rates, right? If you pull down rates, you increase home purchases, you increase purchases of big ticket items, cars, those sorts of things. Lower rates means more demand for stuff. That's what they want. But in the context of these tariff negotiations, or whatever you want to call them, all of a sudden Europe has taken the fiscal spending the uncapped fiscal spending program ball and run with it, because they're going to have to rearm the continent. So defense spending in Germany and France and the UK is going to be insane. Germany
Yeah.
just actually passed their budget today, and I don't know if you've looked at the DAX, or I could probably pull up EWG, which is the ETF for Germany. Let me pull it up and get rid of this, and I'll just share screen. This is a German market since January,
Hmm.
right? It's up 20%,
Yeah.
since the beginning of the year, and it's just gone straight up at a 60-degree angle, and it's not going to stop for a while. So, what I think this is money that has left the United States and has begun to flow into these other markets. So, some of the Substack authors that I'm friendly with and have been on Twitter are talking about, being naked long Europe. European fiscal primacy, I think, was one of the themes that popped up, which is, the ball has shifted from the US over to Europe. So people are long Europe, Brazil, China. China just issued stimulus yesterday. And again, they want to focus on big ticket items as well.
Right.
So
And
right
so
now, the market is long those three markets and either short the US or just there's outflow from US markets.
we like in the temptation is always to oh, we need to invest internationally. Maybe I need to do international promo and product. But like we also know that the problem with that is that it's been historically very difficult to sell US investors on buying subscriptions to
Mhm.
trading international stocks and things like that. And so then the solution, of course, is ETFs, which I know you talked
Right.
to me personally about trading, things like that.
Yeah.
And so I think that seems to be like there's an area there to be able to have the big kind of macro conversations in promo,
Mhm.
and focusing it down using ETFs so that people have the comfort of investing in the US stock market versus having to invest in foreign markets directly.
Oh, exactly. And for a lot of these MSCI country funds, the options chains are relatively liquid. Like Germany's not so bad. So you can move a
Mhm.
subscribership kind of in and out of options or take longer dated views on something through those. And a matter of fact, I think one of the best promos from 22, I think it was 22, was the Jim Rickards promo where they had country ETFs and currency ETFs,
Mhm.
and but they were all generic, kind of, it was macro driven, did really well. And that
Mhm.
was in an environment that was not dissimilar to this, right? Where GDP is kind of, lurching along, inflation is, either, well, then it was much higher. So there's more to do, I think, with that. But like that was a product that was designed for that environment and crushed it.
And
And of
and
course,
that
they
like
have a generational talent in Jim Rickards who can really sell it,
right,
which helps. But
definitely helps.
when you ring something thematically with subscribers that rhymes with the riz of your guru, right? That rhymes with what's on people's minds in general, and is provocative. I mean, those are the recipes for a relatively successful launch.
So
So
one, I'm not sure how I feel about having the word Riz used on my podcast or conversation here, but
yeah,
um,
well, you gotta be hip for the kids, right?
um, no, but but the other part of this then is that like because things are changing like so quickly and fast, right? Like this is a trader's market in a sense. Trading products tend to be easier to sell when things are volatile, like you said. It's more difficult for stock pickers, isn't it?
It is, but this is actually where your options guys should really flourish, right?
Yeah.
Because this is either it's a stock picker's environment or it's a trader's environment.
Hmm.
And when vol is this choppy, I would expect that the options guys are going to do okay, just in
Hmm.
general, because if IV is juicing, premium valuations, right? Then your downside should be at least cushioned to some degree, uh, when volatility is higher.
Yeah.
So, so yeah, they should be doing okay. I mean, how to sell them in this environment? I think webinars are probably superior to VSL promos, because the latter takes a lot of work and it has to be evergreen.
Hmm.
And I don't think we're in a market environment that is evergreen at all. In
Yeah,
fact,
and
the opposite.
yeah,
So
and I think at FMS, I think was it Flagel who on the media and acquisition panel was saying that he thought the live webinar was kind of like the new VSL anyway.
yeah,
And it's
well,
partly
I
because of
think
the
that's I think that's probably right. And the nice thing about it is you can write a deck for those pretty quickly and you can pivot. If something changes, in the market, you can adjust how you frame it and how you contextualize it. You can't do it live, obviously. You have to have some, thought with the sales pitch beforehand, but like you can be a little
Yeah,
bit more flexible with those than you can with
sure,
the VSL.
for sure. And in fast markets, that means you,
Yeah,
you,
that's right.
long production times is definitely a problem, and AI helps with it, but like it's still a problem.
Yeah, but
For certain types of promos.
again, I think the themes right now are money's out of the U.S. and into Europe. I think that's one big theme. And then if you look at the sectors that are doing well, again, it's defensives. It's staples. It's healthcare. I mean, some of the easiest trades this year have been like short home builders. I mean, that basket has just stunk because rates are really high. Inflation has basically made it to the point where normal young people can't afford houses. So buying is completely dried up, and I think you'll see pockets of real estate in Florida and some other places that aren't going to really do so well from a valuation perspective. So uh, you know we're not in 21, we're not in 22, we're not in 23. We're in this new kind of like no man's land, which is going to be, I think, raise consternation amongst publishers. But at least from what I'm seeing right now, there's no reason to, throw the baby out with the bathwater and rejigger your product line. Just be a little bit more thoughtful about how you contextualize your product line with subscribers. That's about it.
Awesome. Cool. All right. So basically then I don't know, like a choppy kind of thing. That's
Yeah,
what
I
it feels
mean,
like.
if there's a takeaway from this, if I had the TLDR, this entire conversation is this too shall pass.
Yes,
But
but you need to make money
yeah,
while it's passing.
yeah,
So
but again, just understand why things are doing what they're doing. Make sure your editorial staff understands those nuances, and if they don't, then go out and get somebody who does know to have some commentary on it. Like I think it's incredibly useful in webinars.
mhm,
It's engaged. I think it's a lot better to watch people talk to each other and have discussions about things than it is to just watch one guy like me, yeah, about the same thing
mhm.
for 30 minutes. It's just, I think it's more rewarding for people. It's easier to listen to, and you can glean more from it.
Yeah.
So
Yeah,
but
webinar live is doing really well, and there's even folks out there now who are doing daily lives as a product and deliverable, and doing promo inside it, and like really engaging with an audience on a real like ongoing basis that way. That it's really interesting to see. So
yeah,
um,
yeah. So it's not great as far as economic outlook goes, but again, I think the worst is by far behind us. For the next year or so, and we're just, this is really just more growing pains than it is
mm,
some sort of economic cataclysm that is about to befall us. Don't get me wrong, I think there are structural issues with the broader market that may come to fruition over the next few years. Certainly from a geopolitical standpoint, my track record is unblemished by success in that regard, as is everyone else's. So we're not going to speculate on what the outcome of Russia Ukraine, and we're not going to speculate on how China is going to respond to that. There's just no point in it. We're going to have to take those in real time as they come. But in general, I think the battle that is going to be waged in markets is going to be over, the Trump administration trying to get the 10-year down, and the fact that their trade policies are going to work in the opposite direction to that. So the U.S. has to refinance its debts, I think, later on this year.
mhm.
And they would love to do that at 3% as opposed to 5%. So, I'd expect this battle to go on. And I do think that there are enough smart people in the administration that they'll get the trade volatility muted to some degree by the time we get to Q3.
Yeah.
But until then, it's just, it's going to be tape bomb after tape bomb, on the news headlines, and the media is going to be all over it. So, buckle up. It's going to be a wild couple of months, but I do think things will get a little bit more boring in Q3, and then start to become materially better in Q1, Q2, just not outstanding.
Right. All right. Well, that's a good place to end it. Appreciate it, Matt.
No problem.
Thanks.
Happy to do it, and thanks for having
Yep.
me on as always. And if anybody has questions or anything, please feel free to reach out to me on the FMS network, tag me in a post or whatever. Or alternately,
Yep.
come find me on Twitter at mfwarder, or God
Mm-hmm.
forbid, subscribe to the Coal Trader.
All right. Thanks, Matt. Take care.
No problem, buddy. We'll catch you.